All right. Welcome back to the weekly rebalance. Number 11 this week. Getting closer and closer to Thanksgiving.
Yep,
Coming along. How's your week started, Nick?
it's been pretty busy, but I can't complain.
Yeah. Nice. Are you taking any time off for the holidays?
Oh, I can't do that. I can't deprive the shareholders being you and Landon, of my value.
That's right.
No, I'm
That's
not going to
funny.
work on Thanksgiving. I usually go out on Black Friday.
Yeah.
I don't ever buy anything. I don't know. I kind of want to like go enjoy the chaos. But it's
Yeah.
been less and less chaotic. So is it worth waking up in the morning?
Yeah. I know what you mean. Everyone's shopping online nowadays.
I know.
And
And they do it on Thanksgiving.
yeah. And Black Friday starts, um, I don't know, at the end of August now. Not
Yeah.
really, but it seems like it starts earlier and earlier. The Black Friday sales have been in force for weeks at this point.
Yeah.
So,
Yeah. I
anyways,
don't
yeah,
know.
it gets
That's the plan.
earlier. Sounds good. Nice. I usually
What
do
about
like to go out and just see what's going on Black Friday as well, but the older and older I get, the less I am interested in that.
I know I
Typically.
have like I don't think I've ever rushed out to buy anything on Black Friday. I don't think there's ever been anything where I go, "Oh, I need to go run out and get that." But
Yeah,
it's just something my family does. We don't even buy it's just like, I don't know.
it's just
We get
entertainment.
up, get Chick-fil-A breakfast,
It sounds pretty good.
drive around, yeah. Although the market's not closed, so you got to go to work at 9:30. It's a
Yeah,
half
yeah,
day.
that's true. It's not the typically the busiest day in the world though, so that does.
No, no.
But you never
Luck,
know what you have.
no, never know.
Yeah. Anyways, sounds good. So those Black Friday, um you were gonna I was thinking I know I looked ahead a little bit at your topic for this week and what you were thinking about with tariffs and whatnot. Do you expect tariffs? How are they going to affect prices for consumer goods
Yeah.
this holiday season? What's your expectation on that?
Well, it's an interesting question because it ties directly to what I was going to talk about today. And a really interesting article that came out by some researchers at the Fed. I think it was last week, and it was published by the San Francisco Fed. There's been a lot of articles popping up about it because it's particularly surprising. I think most people who see the headline and read the underlying article itself are going to be surprised by their findings. I certainly was. Um, so
Yeah.
kind of ties into the discussion I was going to have today. But maybe we'll get started with. It's a good question. I feel like we'll probably see maybe less activity with Black Friday, partially for the reasons you mentioned earlier. It's going earlier and earlier in the year, where there's more and more sales, but also there's just declining consumer sentiment. Consumers just in general weaker right now than maybe they were in prior years. So I think maybe declined activity in terms of higher prices. That ties directly into this article, though. And they specifically were studying the impact of tariffs and tariff shocks on inflation and unemployment. And
Okay.
what they found was a consistent story, both before World War II and after World War II, which I think after World War II is very noticeable or notable, given that's more in the modern day. But the relationship held up that actually, with the increase of tariffs, inflation tends to trend downward and unemployment tends to trend upward,
Interesting. Okay.
which is not what you would typically expect in a vacuum. When you're
Yeah.
doing Econ 101, you're drawing supply and demand charts. It's obviously we're taking a hit to supply here, and we're moving it up so the price goes up. But what they found is that it seems that tariff shocks or the implementation of tariffs typically impact the demand curve more than they do the supply curve, and that ends up resulting in this really interesting trend where we're passing on tariffs, which you would think increase prices, but they actually reduce inflation, historically speaking, very consistently, and increase unemployment.
Interesting. Okay. Well, and we've, started to see some of that already with the weakening labor market. That's
Yeah,
been a major concern. That's what the Fed is citing as their reason for continuing on this path of lowering interest rates, which we'll see what happens here in December again, but still pretty good chance that they lower interest rates in December. But their sole citing there is that the labor market is weakening and they're having trouble with unemployment and stuff like that, right?
yeah, yeah. That's been the story for the most part. I think
Yeah.
it's interesting, particularly the inflation side of the story, because in theory, that would mean we're more likely to get more cuts because if we're getting declining inflation or tariffs are resulting in downward pressure on inflation and also upward pressure on unemployment, that seems to be the perfect recipe for a rate cut.
Yeah.
So, really interesting article. I recommend everyone read the paper. It's a really great read. It gives a lot of great history about tariffs throughout the history of the country, but also taking a look at France and the UK and their history of tariffs and how that looks in their economy as well. And they find a similar relationship.
Right.
And basically coming back to downward pressure on inflation, upward pressure on unemployment. And there's a couple reasons that they cite for this that are potential causes for that.
Yeah.
And those two things being the uncertainty that it introduces. So when there's a lot of uncertainty in the market, hiring ceases, potentially some layoffs. And then on top of that, stock markets tend to pull back, particularly when there's a large surprise to the upside on tariffs.
Okay.
And so there's an aggregate decrease in wealth, and that also
Hmm.
puts downward pressure on prices with so brings down inflation, but it also decreases the ability to hire more people and potentially need to lay off some people.
Yeah.
So really interesting paper that they do a great job of diving into it. We could talk about all sorts of interesting things in there, but I don't want this to be a 2 hour
Hmm.
podcast.
Yeah. We
I,
should
I
do we should do a deep dive on it.
Yes, I highly recommend anyone read it. It's really not that long of a paper in terms of a
Yeah.
academic research paper. Very digestible, just really great research. But ultimately, what they found was consistently. Uh, Let me verify how far back they look. So I think they go back to 1870 in the
Oh,
U.S.
wow. Yeah, that's good long-term data there.
Yep, 1870. So they're looking back 1870 through modern day and looking at all of the tariff
Interesting.
regimes that we've had throughout that period of time. Specifically, there's a great portion of the uh, document that dives deeper into each one of the specific tariff implementations or tariff regimes that were present in the US throughout those 150 years.
Right.
And it's really interesting that they talk about a lot of things about the statistical nature of it and how it's actually prime for doing this kind of research, given that it's typically not correlated to the business cycle. So you don't have too many outside variables impacting the results in terms of inflation and unemployment. Because back in the day, they go into this in the article, but really Republicans were all about let's lower tariffs. I mean, I'm
Yeah.
sorry, I have that backwards. Republicans were all about let's increase tariffs, and Democrats were for let's bring tariffs down. And that largely results from back then, a lot of the South was Democrat country. So they were voting Democrat. And
Right.
they were a net exporter, whereas in the North, it was more industrialized. Um,
They're net
and
important.
yeah, so they were more hurt by imports that were cheap. So they were
Interesting.
pushing for higher tariffs.
Yeah. Well, that makes sense. Well, and like we said, the job growth has slowed, right? I mean, we've had the tariff news has been in place for months, many months now, right? We're starting to see some of the effects. And yeah, job growth has slowed. The unemployment rate has risen a bit. Layoffs have started to rise. And yeah, it's definitely but inflation has been largely in check, comparatively speaking. Now, I think my personal opinion is there's still some concerns there,
Yeah.
but that data, you know, lends to a different story. So, definitely something to look into in a little bit more detail, and good to know the historical context. I think that's one of the things that I think as investors, advisors, portfolio managers, whoever's listening to this and thinking about these trends from a historical perspective is extremely important, and really a long-term historical perspective, because just like we it's very commonplace to be having these conversations about, well, the last 17 years growth and tech have provided the performance, and quality dividend payers value have not. But that is that trend, historically speaking, when you zoom out to a much longer time period, like the last 100 or 150 years, that's not true. That's not always true. There's rotations that occur. Um, but if you just look at the last 20 years, and even if somebody looks at just their career, um, even if you have a long tenured career and you've been in the field for 40 years, you're really looking at a very short window. 40 years, which let's say is most people's working window, 40 years is not that long. You're not going to see all the potential cycles, all the potential trends occur. I mean, look at it. The inflation's a perfect example in the bond market in 2022. 2022, we see almost 20, more than 15% drawdown in bonds, which hadn't happened in many decades. Most people that are managing money at this time in 2022 had never seen that in their career. In fact, I've never met anybody that actually managed a bond portfolio through the last inflation issues. And it's just how it works, right? So, anyways, I think it's really important to study that history. That's why one of my favorite books is Ray Dalio's book on he has a number of good books on this, but the Changing World Order book is really, really valuable in my opinion from that perspective, because it studies beyond even just the last 130 years in US, mainstream stock markets. It goes further and looks at how countries rise and fall. And I think that's really important to keep that in perspective, because if you forget about that, you forget that, well, what happened the last 10 years is not always what's going to happen the next 10 years.
Yeah.
It's very easy to fall into that trap though.
It really is. And I think that's interesting too, just thinking back on value versus growth,
Hmm.
specifically in the context of the Carhart model, which is just
Yeah.
a very well established model for determining the expectations in the market. But there's a specific factor in there that's value.
Hmm.
When the research was done, they found that over however many years they ran the study, which was extensive, they found that value companies on average outperformed growth companies. So value as that factor um, led to better returns, or at least that's
Right.
the expectation that's driven in this model. And there's other things like size, where they expect small cap to outperform large cap, that sort of thing. But
Right.
just specifically in that context, just actually the established knowledge says value should, on average, outperform growth
Right.
in
Small
the
cap should
longer term.
outperform large cap. Yep.
And maybe
Which
we
has been
just caught
the
like a really weird period when they were doing the Carhart model. But
possible.
I tend to not think so. But potentially, like maybe there
Yeah.
was just a huge regime change. Now we're
Yeah.
in somewhere
That
else. But
that has to be considered as well, but you're right. Like we've been in a period the last 17 years where all of those tr models have been challenged. But again, you have to just, I think, regardless, you could be in a period, we could be coming out of a period where value has just done phenomenally, right? And you could have the exact same argument. But I think it lends back to the discussion that we need to take a longer term historical perspective on these things. And you can find patterns in history, even though every things are different. You can find patterns, like, and this is, leading into a little bit of what I was, you know, planning on discussing a little bit more today because I think we've obviously seen some volatility in stock markets. We've seen compression, modest compression of some of the top AI names, the AI focused names. And, I wanted to, again, bring some perspective to what that has looked like historically, because yes, it's different, right? We're talking about the AI era versus other different types of technological innovation, but these have all happened before, right? It's just different. It's AI or electrification or the computing age or the industrial revolution. And these things, they're really important to pay attention to.
For sure.
Yeah. So, I mean, just looking through some of the history and why it matters, every major technological shift, the Industrial Revolution, I focused on it just a couple here. The Industrial Revolution, electrification, computing, as the primary ones. And if you look at them, like let's just go through them really quickly here. The Industrial Revolution. In 1880, about 40% of US workers were in agriculture. By 1960, so 80 years later, that's only 6%, right? But it did take 80 years, right? That's just how it works. It displaced millions, but it was replaced with a bunch of new factory jobs and higher living standards and education and whatnot, but it affected the whole economy. It wasn't just, that one particular sector. Electrification, the next one, took about 30 years to fully transform basically factory work from pre-electrification to post. What happens is productivity soars, right? And it creates a lot of uneven transitions, where people are displaced. But again, it takes decades to fully realize what's what the new adoption of the technology is. And then the computing age is another one, right? Um, that's been really going on since the 80s. Automation has replaced tons of jobs, um, but it's replaced more. It created more than it actually displaced. So, you could look at a more modern one as robotics and AI. That's the next phase. And I really, the way I look at it, it's likely to kind of shake down in a series of developments, and we're really from my perspective, in the very beginning, which is why I'm very bullish about it long term. However, when you start to, I think, to really truly be bullish, you have to be bullish that it's going to affect the entire economy, not just 5 to 10 stock names that are at the top of the market cap right now. You know what I mean?
Yeah, I totally agree.
So I don't, and it likely, I think this AI adoption could go faster potentially because it's very user friendly. I mean, just for example, my mom and aunt, I was teaching them how to use ChatGPT, and they're figuring it out. They figured it out in a 20-minute tutorial, right? Very different than the Industrial Revolution. However, I think it still takes decades, and we're really at the beginning where, from my perspective, we're in this phase one where all the initial adopters are really reaping the benefits right now. But, you're likely go into another phase where the trickle down spending affects data centers, utility companies, et cetera. And then you go into a phase where productivity should soar, right? Coming from increased ability for companies to not have to hire new workers and get the same productivity out of their current staff. And then you'll see companies in the healthcare space and, potentially in autonomous driving and whatnot that are able to actually monetize the new products that are coming from AI. But that's going to trickle down throughout the rest of the economy. That's what has to happen if you're truly bullish on AI. This is not just, five stocks that are the beneficiaries. The whole economy should be a beneficiary of the space of this new technology. That's my opinion on it, which means that again, the valuations in stock markets, they should, it's not just going to be concentrated in 5 to 10 names for the next multiple decades. I think those companies may still do wonderfully, right? But there's a lot of other names out there, a lot of other companies, the rest of the economy that's going to develop around this new technology.
Yeah, we're still early in this whole thing.
Yeah.
For sure. I think that's an interesting point about how user friendly it is, just because you really don't even have to interact with your phone anymore. You don't have to type anything in. You can just talk to it, which
Yeah.
I think is really interesting. Now, in terms of practical applications, how much you can use that type of thing for a real practical application beyond just maybe asking a question or things like that. Maybe that gets a little bit more complex, but still, it's becoming increasingly accessible. You don't even really need to know how to code anymore.
Right. Yeah, exactly. Totally. It's extremely user friendly. So, which I think will help with the adoption. It'll make the adoption faster, the adoption cycle faster. But I still think you're talking about decades of adoption here versus a couple of years, which we're really in like the first couple of years here. But yeah, I don't know. I also saw an interesting article, and I want to dig into this a little bit more. Maybe we can on another podcast. But I sent this to you. I don't know if you got the chance to read it or not yet. But do you know the supposed, and I'm gonna have to verify this stuff later, but do you know the supposed depreciation schedule that most of these companies like Oracle, for example, are using to depreciate their technology and expense their R&D costs?
Well, I only know because you told me right before we hopped on the call, but I think it's 6 years, right?
Yeah, 6 years. I forgot we discussed that. Did
You
I
should
really
save
tell you
that for the
that
trivia.
before?
Should have
I
saved that for
should
the
have.
trivia. I've never given away my trivia questions.
Sorry. Did I really tell you that before?
You did, yeah. We were
Oh,
talking about it
geez.
right before we hopped on.
Sorry. Well, yeah, exactly. It's about 6 years supposedly. I need to verify this because I just saw this recently. So a client sent it to me. A good CPA client that's pretty adept at this stuff sent this over to me. And so I need to verify some of this. But if that is true, which I believe he's correct, he, I mean, think about the actual depreciation schedule and how much faster these companies would have to recognize the expenses associated with the depreciation of the assets. In reality, NVIDIA, for example, is coming out with new chips every 18 to 24 months. So that's a 3 to 4x faster depreciation schedule than real, which would significantly affect their actual reported earnings. And the article basically is this was citing that Michael Burry, the Big Short guy, was citing that as his reason for taking about $1 billion short position in some of these major names like Oracle and NVIDIA and whatnot. So I got to dig into that a little bit more. I don't know that I'm on that page where I'm ready to start shorting those names. Um, but I am in the camp of just trying to remember from a historical perspective that this has to trickle down to the rest of the economy to be truly bullish on it long term. It's not just going to be 5 or 10 names for forever. It's going to trickle down to the rest of the economy and truly in, ingrain itself in our everyday lives. And we're still such at the beginning of that at the moment. So I don't know what you think of that, but that's my uh that's my thoughts
Yeah,
for now.
you really are. And that's kind of the other thing too with that depreciation schedule. I mean, on its surface, 6 years does seem long, just given how fast technology evolves.
Right.
But I don't know enough about the life of whatever products they're depreciating. I'd imagine it's chips in some cases, other technological components in others. I don't know enough about the actual useful life of that enough to make an intelligent judgment as to whether that's appropriate or not. On its surface, I see what you're saying, where they come out with a new chip every 6 months,
Right.
and So maybe it's less useful, like that real estate potentially, or that power usage would be more efficiently spent elsewhere, but it's still actually got use to it.
Usable.
Um,
Yeah.
but yeah, it's really something I'd like to dig into more on, because it it certainly has helped their earnings if it should be depreciated over a 2-year schedule as opposed to a 6-year.
Right.
But I just don't know enough to say whether that's appropriate or not. Because if they're still getting use out of it, then maybe that's right. But
Correct. Yeah. I don't know. I want to dig into it a little bit more, but it was a very interesting perspective. But I definitely want to dig into it a little bit more because yeah, they're just backing up from getting too technical into the detail, which we haven't had, neither of us have had the chance to look into that in enough detail to make any conclusions on at this point. But I think it is true if you look at technology nowadays. I mean, I just as a company, we've had trouble keeping computers around more than a couple of years because they cannot handle the increased, processing power needed to run the systems that we run on a day-to-day basis. I mean, I go through a computer every 24 months almost, you
I,
know?
I know, yeah, it's tough. It's tough. So I'd like to learn more about it.
Yeah, I think that's something we need to dig into a little bit more from a research perspective. But just being aware of that, I thought it was a really interesting article, an interesting perspective. So we'll see. I'll have to ask this client. I'm also a client as my accountant. So what's funny is he would actually do the depreciation of our technology here at Revisor, and I don't
Yeah.
actually know what schedule he uses to depreciate our, computers and technology that we purchase. But I don't think it's 6 years because
Probably
I,
not.
I don't think it is. But I'd be really interested in that. We're obviously a very different company, but I'm gonna have to have that discussion in a little bit more detail with him because it's an interesting one. He would probably be able to shed some light on that.
Yeah, it really is. It really is interesting because too, obviously that bleeds through to earnings because it's depreciation. But in terms of
Right.
cash flow, we're really somewhere else in another world there. We're not, we're outside of
Right.
depreciation. So yeah, that's just an interesting thing to talk about. Obviously, we talk about the earnings growth and how substantial it's been, and that sort of thing. But in terms of looking at a growth company as a whole, I'm not really looking at the balance sheet as
Right.
an investor typically.
True.
It's something to consider for sure. Um,
True.
and it does bleed through to earnings, which obviously affects growth rates and all of
Right.
that. So it's definitely not something to ignore. I just find it an interesting thing to really dive into, and certainly worth looking into, just given that we're looking at growth companies here. We're not looking at, um,
Right.
Caterpillar or something like that.
Right. Yeah. Very different. But I think it would at least, if investors, a lot of investors piling into this stock, these type of stocks are retail investors, or people that aren't paying attention to balance sheets. And I think, just generally speaking, you would at least, some investors would reconsider the price they're willing to pay if those accounting metrics were adjusted. Maybe
Well, yeah,
not,
especially
but
if they're not
yeah,
accurate. I think that changes everyone's calculus on it.
right.
It's just particularly interesting to consider depreciation in the context of a growth company. Not that it
Yeah.
doesn't change the outcome. If it really hurts earnings and all of a sudden they're not actually turning a profit anymore because they're accurately depreciating their assets, then that's a huge deal.
Yeah, yeah, exactly. So
But
definitely something to look more into. I'm going to spend a little bit more time digging into that. Maybe both of these topics could definitely be digged into and or be dug into a little bit more thoroughly on some future calls and podcasts and some research as well, because I think they're well worth the time spent on them. It's very, very interesting.
yeah, there's a lot to dive into here.
Yeah, definitely a lot to dig into. So, anyways, but that was were my thoughts for the week. And I think, going into the last part of the year, as an investor, we had a call this morning covering this with a group of our advisors as well. I think it's just one of those times we're in a position where I think volatility is just kind of to be expected. It's a really good time to discuss and remind investors of this longer term historical perspective and just make sure that they're allocated properly and educate them on why, it's a good time to educate or make sure that your portfolios are diversified properly, allocated the right way, that, it's a good time to talk about risk and make sure that that's all in line. Especially very likely have we have already started to have a little bit of a period of volatility, but they come and go. And very possible that we have a heightened period of volatility here in the last part of the year and beginning part of next year. So good time to have those discussions.
Yep, we've certainly seen that so far. I think
Yep.
one of the longer losing streaks in a while for the S&P 500. So
Yeah, absolutely. But these are normal. They are normal. That's another thing as a to remind yourself of that these periods, these times are normal. They happen. They've happened before. They'll happen again. Um, just a good time to check in and make sure everything's still in order.
that's a great point for sure. Well, do you have any trivia for me for this week, or did you
No,
spoil it?
I spoiled it. I spoiled
Oh,
it by apparently didn't even remember telling you my trivia question, the answer to my trivia question.
oh
So
my gosh.
sorry. I think it'll be a one-sided trivia this time.
This time, the past 3 times. It's fine. It's fine.
Sorry.
I've got a two-part one here, and it ties
Okay,
back to my discussion earlier about tariffs. All right.
sounds good.
We'll we'll start with this. Which president is on the $100,000 bill?
The $100,000 bill?
Yep. I wouldn't know. I would just guess.
I don't know. Trump.
Trump. It's a little bit late. That's a little bit late. At the time, so it was Woodrow Wilson. They
Okay.
issued these bills in 1934. They were in circulation through 1969. Now, the interesting thing is they weren't truly in circulation because it was actually and still is illegal for an individual citizen to own a $100,000 bill because it's too
Really?
large. There's just too many concerns with moving money around. You can move $1 million around with your wallet.
Yeah. Yeah.
you know, so actually illegal to own it. Now, the Federal Reserve and I think the Smithsonian, they have one because you can have it for educational purposes,
Okay.
but they stopped circulating it in 1969. It was used to settle payments between the Federal Reserve, and it was actually a gold certificate, so it represented the amount of gold that you could
Gotcha.
redeem it for, and going back and forth between the central banks, so or the Federal Reserve banks. So that was really interesting.
Interesting. Yeah. I did not know that.
Now this ties to Wood. I don't. All right, I already said this ties to Woodrow Wilson. But what was the first year for federal income tax?
1944.
Little, or I mean, a little late. 1913.
Oh, okay.
And
1913. All
Woodrow
right.
Wilson was the one who introduced it, actually. And it was
Really?
part of a sweeping package that changed tariff rates. So we're
Okay.
coming full circle here. We're coming full circle.
Interesting. Full circle. I like it.
Yeah, it's all tied together. It's all connected.
1913. Okay. Was the
In
first year
19,
for federal income tax.
that's correct. And it came with a reduction of tariff rates by pretty substantial margins. They reduced tariff rates by 40% down to
Okay.
an average of 26%. So tariffs on average were 26% after the 40% reduction.
Okay. Interesting.
So Woodrow Wilson, being a Democrat, he wanted to lower tariff rates. Again, that's just kind of in keeping with that story that was
Yeah.
present at the time. Now, I think around that time, Republicans were starting to get mixed on their feelings on tariffs.
Okay.
Some of them were starting to feel like maybe we should lower them. Some of them were still pretty stuck firmly in the camp that they should be higher. So that's starting to change around that time as well. But in this particular case, Woodrow Wilson reducing tariff rates and introducing federal income tax. So you can thank him when April 15th comes around.
Sounds
And
good.
basically introduced our long-term reliance on income tax as opposed to tariff income, which is something you hear Trump talk about from time to time.
Right, right. Now he reduced tariffs by, you said 40%. Now that did flip around back in the 20s again, right, with
Yes.
Smoot-Hawley.
Yes,
Um,
exactly.
was that I don't remember when Smoot-Hawley came into effect, but it was like the mid 20s, right? And
Yeah, I think it was 20s, almost early 30s. Hold on. It's in this paper here. I can't remember off the
that
top
was
of my
the
head.
last time that we had an increase in tariffs significant in comparison to what we've had this last 12 months,
Looks like it was
right?
the end of the 20s. Yep. That's correct. Now, Trump did increase tariffs a little bit in his first term as well.
Right.
And there were a few fluctuations in the 70s, 80s, but not
Not to the degree.
not to the degree of Smoot-Hawley.
Right.
But yeah, very interesting. I was a little bit surprised it was 1913 for the introduction of federal income tax.
Yeah,
Um,
I'm I was obviously off there too.
yeah, really interesting too, and it ties back to the Civil War as well. Just using tariffs to actually offset the costs of the Civil War. Grant
Right.
was uh, pretty instrumental in tariff policy for a number of years when he was president after the Civil War, but paying
Yeah.
down the debt from that was
Yeah.
largely from
Very interesting.
tariffs, so needed higher tariff rates to offset that, which obviously the North and Republicans liked.
Right. Yeah, very interesting.
So it's all connected today. We're
All
coming back full
connected.
circle.
Bringing things full circle. Getting
We're
better at
bringing things
this.
full circle here. Let's see. Did I miss any fun facts about the $100,000 bill? I don't think I did. That's crazy that it's illegal to own it. I mean, I get
Yeah.
why, but that is kind of crazy.
Yeah, it is kind of crazy. Interesting.
Apparently
Well,
you need a
thanks.
big
I'll try
chunk.
to remember for next week to actually bring some trivia
Oh my
and not
gosh.
give it away
Finally.
before I get on the call.
Exactly. Exactly.
Awesome. Well, any closing thoughts for today, or is that everything you got for this week? All your thoughts
No,
for this week?
no, I want to keep it all connected. So that's it.
So sounds good. Well, I didn't have anything else either, so I guess we can wrap it up for the day. Thanks everybody for listening, and we'll be back again next week.
Sounds good. Bye everyone.
Bye.